Let's get right to it. Today, we're witnessing a dramatic shift in the global financial landscape, one that's sending shockwaves through every major market. The market is a sea of red, and here's why. Across trading floors and digital screens, losses are mounting at a pace we haven't seen in months. A tech-led sell-off started on Wall Street and is now spreading globally. What began as a few big names losing ground has quickly turned into a worldwide rout. This isn't a minor dip, it's a broad momentum unwind. The speed and scale of the decline are catching even seasoned investors off guard. Investors are cashing in their tech gains and de-risking ahead of a major event. Many are locking in profits, while others are simply trying to limit their losses. This is classic risk-off behavior. When uncertainty rises, the instinct is to pull back, reduce exposure, and wait for clearer signals. The numbers tell the story. Europe's stock 600 fell, erasing weeks of gains in just a few hours. German shares dropped even more, with the DAX plunging as investors reacted to both local and global pressures. And the UK's FTSE 100 slipped after hot inflation data. Rising prices are fueling fears that central banks may have to act more aggressively. Asia's markets followed, with the MSCI Asia-Pacific Index down sharply. From Tokyo to Sydney, the sell-off is relentless. This is a coordinated global move, not just a bad day in one country. The interconnectedness of today's markets means pain in one region quickly spreads to others. The epicenter? Tech stocks, especially in Taiwan and South Korea, the world's chip makers. These companies are the backbone of the digital economy, so when they stumble, the ripple effects are massive. When these markets get hit, the fear is real. Investors know that weakness here can signal trouble for the entire global supply chain. Investors are selling first, asking questions later. The bottom line? Uncertainty. No one wants to be caught on the wrong side of a fast-moving market. The market hates it, and right now there's plenty. Questions about the Fed, government intervention, and global tensions. Every headline seems to add fuel to the fire. All these factors are forcing investors to the sidelines. Many are choosing to wait it out, hoping for a sign that the worst is over. This isn't a time for heroes. It's a time for caution. The mood is defensive, and the appetite for risk is vanishing fast. The pain is everywhere, and the world is moving in sync. It's rare to see such a unified reaction across continents and asset classes. When the whole world sells, you need to pay attention. This kind of synchronized selling is a clear signal that something bigger is at play. The message is clear: risk is out, safety is in. Investors are flocking to safe havens like gold, cash, and government bonds. Until there's clarity, expect more volatility. Sharp swings and sudden reversals are likely to be the norm for a while. The smart money is waiting for the smoke to clear. In times like these, patience and discipline are more important than ever. Stay cautious, stay informed, and remember, sometimes the best move is to wait and watch. Now let's talk about the main event, the Jackson Hole Symposium. Every year, this gathering in the scenic mountains of Wyoming becomes the epicenter of global economic attention. Central bankers, economists, and financial leaders from around the world converge here, and the stakes couldn't be higher. Every investor is waiting for Fed Chair Jerome Powell's speech. His words have the power to move markets, shift investor sentiment, and even influence the direction of the global economy. The market wants a roadmap. Will there be more rate cuts, or will the Fed hold steady? Investors are searching for any hint, any clue about what comes next for interest rates and monetary policy. Traders are betting on another cut, but what if Powell surprises them? The uncertainty is palpable, and even a single unexpected phrase could send shockwaves through the financial world. This speech is all about managing expectations. Powell knows that every word will be dissected by analysts and investors alike, looking for signals about the Fed's next move. Powell must balance sounding concerned without spooking markets, and optimistic without killing hopes for cuts. It's a delicate dance. Too much caution could trigger panic, while too much optimism might make markets complacent. It's a high-wire act, and the world is watching. Journalists, analysts, and policymakers from every continent are tuned in, ready to interpret every nuance. Think of the market as a patient, and Powell as the doctor about to deliver the diagnosis. The right words can calm nerves, but the wrong ones could spark anxiety or even panic. No one wants to make big bets before hearing from him. The atmosphere is tense, with traders and investors holding their breath, waiting for clarity. That's why we're seeing de-risking and caution. Portfolios are being adjusted, and riskier positions are being trimmed as everyone braces for potential volatility. Investors are clearing the decks for Friday's news. It's a classic case of wait and see as people prepare for whatever surprises may come. This is the Super Bowl for Fed watchers. The anticipation is electric, and everyone wants to be ready for the next big play. The game is about to begin, and the outcome could shape markets for months to come. All eyes are on Jackson Hole. Let's dig into Powell's dilemma: inflation versus jobs. The Fed faces mixed signals, confusing inflation data and a job market that's sending its own message. The CPI and PPI aren't in sync, making it tough to read inflation's true direction. The Fed's dual mandate is stable prices and maximum employment, cut rates to help jobs and risk inflation, keep rates high and risk job losses. There's no perfect answer. That's why Powell's Jackson Hole speech is so critical. Investors want to know which risk the Fed fears most. Every word will be analyzed for clues. The market is trying to read Powell's mind. Uncertainty is poison for stocks. Until there's clarity, nerves will rule. Now let's shift gears to the CHIPS Act and government intervention in tech. The US government is considering taking equity stakes in companies like Intel in exchange for CHIPS Act funding. This is a huge policy shift. Uncle Sam wants a seat at the table. For decades, the government regulated, not owned, big business. Now political risk is front and center for tech investors. Who gets funding? How much equity does the government take? This isn't just about Intel, it's about the entire tech sector. If the government does this with chip makers, who's next? It blurs the line between public and private sectors. Investors must now factor in political risk. It's another layer of uncertainty for tech stocks. That's why the sector is getting hammered. Want to see government intervention in action? Look at the Nvidia deal. Nvidia wanted to sell advanced chips to China. The US government allowed it. But with a catch, it takes 15% of the revenue from those sales. This isn't just a tax, it's a direct cut of the top line. The Commerce Department is now a business partner. This is a massive shift from free market principles. National security is now leverage for financial concessions. Investors are spooked. What happens next time a tech giant wants to do business overseas? Will every deal require a government revenue share? The Nvidia deal solved a short-term problem but created long-term uncertainty. The rules are changing, and the market is scrambling to adjust. This is a new era of government involvement. The implications are huge. Let's talk currency. In the world of finance, currencies are more than just paper and coins. They're a reflection of trust, stability, and global power. When uncertainty strikes, people and institutions look for a safe haven, and more often than not, that safe haven is the US dollar. In times of fear, money runs to safety, the US dollar. It's the world's reserve currency, trusted by governments, businesses, and investors alike. When markets get rocky, the dollar becomes a magnet for global capital. The dollar is gaining ground as investors sell riskier assets. We're seeing the dollar index climb, reflecting a surge in demand as people move out of stocks, emerging market currencies, and commodities. The euro slipped, capital is flowing into the US as investors seek shelter from volatility. This shift isn't just about numbers on a screen, it's about confidence. And right now, the US is winning that confidence contest. A strong dollar makes American goods pricier abroad and debts harder to repay for those who borrowed in dollars. For US exporters, this can mean tougher competition overseas, while foreign borrowers face rising costs as their own currencies weaken. Smaller currencies like the New Zealand dollar tumbled after their central bank cut rates. Lower rates make a currency less attractive, and in a risk-off world, investors quickly move their money elsewhere. Investors are seeking safety and higher yields. US Treasury bonds, backed by the full faith and credit of the US government, are seen as one of the safest bets, drawing in even more global cash. The British pound bucked the trend, rising after hot UK inflation data. Not all currencies are moving in the same direction. Sometimes local factors like inflation or central bank policy can change the game. Higher inflation means possible rate hikes, making sterling more attractive. When a central bank signals it might raise rates, investors take notice, hoping for better returns. But the big story, in a fearful world, cash is king. And the king is the US dollar. Its dominance shapes everything from trade to investment flows, and its strength can be both a blessing and a challenge for the global economy. Currency moves ripple through global markets. Every shift in the dollar's value sends shockwaves across continents, affecting everything from stock prices to the cost of living. Central bank decisions can swing currencies fast. A single statement or policy change can trigger massive moves as traders and investors react in real time. The dollar's strength is a sign of global anxiety. When headlines turn negative, the world's money rushes to the greenback, amplifying its power. Watch the greenback. It's telling the story of fear, hope, and the shifting tides of the global economy. This isn't just an American story. Global markets are feeling the pain. Europe's major indexes are down, reflecting fears of a slowdown. The UK faces hot inflation and tough choices for its central bank. Central banks everywhere are caught between fighting inflation and supporting growth. In Asia, the sell-off is even more intense, especially in tech-heavy markets like Taiwan and South Korea. These countries are vital to the global tech supply chain. When their markets fall, it's a warning sign for everyone. The US tech sell-off and Fed uncertainty are fueling global anxiety. Markets are more connected than ever. A shock in one region spreads fast. Right now, the world is moving together, and it's not in a good direction. As if economic uncertainty wasn't enough, the war in Ukraine remains a major wildcard. Recent peace talks ended with no breakthroughs. Uncertainty lingers. President Trump promised security guarantees for Ukraine, but no US troops on the ground. What does guarantee mean? The market hates unanswered questions. The conflict keeps investor confidence low and risk high. The war's impact is felt in commodities, especially oil. Hopes for a peace deal could change sanctions on Russian oil, but with no deal, volatility remains. Oil prices are swinging. Brent crude and US crude are both volatile. The war is a key variable in the energy equation. As long as it drags on, expect more market swings. Geopolitical risk is here to stay. Investors are watching every headline. The uncertainty isn't going away. So, what should you do in this storm of uncertainty? First, don't panic. Panic is not a strategy. Focus on quality. Own strong companies with real earnings, not speculative bets. This is a time for careful stock picking, not blind buying. Be patient. The market is waiting for clarity from Powell, government policy, and global events. Sometimes the best move is no move at all. Let the dust settle and watch for real opportunities. The market is forward-looking. It's pricing in bad news now, but recovery will come. Have your shopping list ready and some cash on hand. Turmoil creates opportunity for the prepared. Stay disciplined, stay informed. Don't swing at every pitch. Wait for your moment. Remember, markets recover. Be ready for when the buyers return. Booyah!